Hey everyone, in this video we're diving into the concept of the optimal trading zone and precise trade entry, as outlined in ICT style strategies. This concept primarily depends on Fibonacci retracement zones and call price swings to identify the start of potential impulsive moves and outline probable targets. We've broken down this trading framework into three simple stages: the analysis phase, trade execution, and trade management. We'll show you how to merge this idea with market structure, fair value gaps, and higher time frame key levels to catch a high quality setup. So if that sounds good to you, make sure to smash the like button to support us and subscribe to the channel if you're new. Catch you right after the intro and disclaimer. When loading the charts, the initial step we take is to mark out price swings and critical structure zones. Put simply, a top-down analysis starting from the higher time frames down to the lower ones helps us build a complete picture of market behavior across different levels. When referring to higher time frame key zones, we mean the weekly, daily, and 4-hour time frames. Anything under 4 hours is typically too short-term for major institutions to effectively structure their strategies. If price declines from a higher time frame resistance area, we can infer that large players were looking to sell from that region. On the other hand, if price moves upward from a support zone, it signals institutional interest in buying at that level. This method keeps us away from minor intraday noise. Instead, we pay attention to impactful moves that reveal where the real market movers are active. Such broader trends are visible on higher time frames, which we've consistently highlighted as essential for proper evaluation. So recognizing higher time frame swings and key zones gives us stronger clarity on market direction, helping us avoid being positioned against the trend. After that, we can narrow down to smaller time frames such as the 1 hour and 30-minute charts to locate precise trading setups. When observing the chart, you'll see that price action consistently unfolds in impulsive and corrective phases. This fractal behavior is a result of how market participants interact. Impulsive moves typically drive price further with strength, shown by candles of the same color and larger bodies on the chart. In comparison, corrective phases signal uncertainty, reflected by candles of various colors, smaller bodies, and horizontal wicks. Spotting where a pullback concludes and the next impulsive leg begins can be extremely rewarding, as it allows traders to take advantage of strong buy or sell setups within the market. Picture an uptrend scenario where the goal is to buy low and sell high to take advantage of the bullish momentum. We can't jump into a long position just yet because the price is elevated and could reverse at any time, so it's smarter to wait for a retracement to enter at a more favorable level. The most recent impulsive leg started from this point and moved up strongly to this high. The pullback will occur within this zone, and once the market builds sufficient liquidity and buyers return, it's likely to push upward once more. If price breaks below this point, it suggests buyers have lost control and the uptrend narrative may no longer hold. This implies strong bearish pressure and could point to a trend reversal unless it's a false break meant to sweep liquidity beneath this low before heading up again. Returning to our retracement zone, here's the critical question: where is the ideal spot to open a long position and engage the market? Entering too soon could lead to deeper downside and a loss despite accurate analysis, but waiting too long risks missing the move as price climbs without us. The secret to trend-based trading lies in spotting the conclusion of the pullback, which signals. This is exactly where Fibonacci retracement levels become essential. We always draw this tool from the origin of the impulsive leg to its termination because it allows us to map out the correction zone. After applying it, you'll see multiple key levels appear on the side. Each of these levels can serve as support and potentially halt or reverse the price when tested. However, two particular retracement points form what is known as ICT's optimal trading zone, or OTE. Those are the 61.8% and the 78.6% retracement levels. There are several reasons why this area is viewed as a prime spot for trade setups. Reason number one: increased risk to reward potential. We understand that no matter where we enter, our initial profit target will be this prior structural level. When the price revisits this level, some traders will partially close positions or take full profits, while others may initiate fresh longs. This causes a reaction or sometimes a reversal, making it our logical first take profit target. If we enter within the OTE, our risk to reward setup becomes more favorable. We always aim to have at least a 1 to 2 risk to reward ratio, and that's why positioning within the optimal trading zone creates a higher return profile and a more logical trade. Reason number two: more reliable entry. The market often hunts early buyers, using them as liquidity for the next wave. This is why patiently waiting for the price to dip into the OTE and then confirming a signal to go long can significantly improve win probability. Naturally, every method has its trade-offs, and in this case some opportunities might be missed due to our cautious approach, but skipping a setup is still better than taking a premature loss. Reason number three: more protected stop. The ideal zone for placing a stop loss safely safely away from normal volatility is just beneath this swing low, because if price breaks below this point it signals a shift in structure and the potential bearish turned bulls are likely to defend this level, so setting a stop near it makes the trade more defensible. This is the third reason why entries inside the OTZ are more calculated. With all that said, identifying a valid reason to take a position within this zone can lead to high probability trades. This confirmation could come from various price action cues, which we'll break down later in this video. Now that we've outlined the optimal trading zone, let's dive into ICT's optimal trade entry framework. This method is broken down into three straightforward phases: analysis, execution, and trade management. Starting with the analysis stage, as previously mentioned, this technique follows a trend continuation model where the goal is to pinpoint the end of a pullback or correction and align our trade with the prevailing market trend. In the initial step, we determine the overall market direction along with the most recent impulsive leg. We only apply this method when the trend direction is clear and the latest impulsive move has broken a recent structure, confirming it is a valid swing. At this point, there's one more thing to evaluate. We need to make sure there's adequate space for the price to continue before approaching a major level on the higher time frame. If price has already interacted with a high time frame supply zone, we avoid entering a long position without some sort of confirmation, because such levels can often cause the trend to reverse even if it was previously bullish. So overall, during the analysis phase, we pinpoint the market direction, identify the latest impulse wave, and gauge the distance to the next higher time frame zone. The next phase is execution. In this step, we wait for a pullback and apply the Fibonacci retracement tool from the beginning of the impulse to its end. Then we set a buy limit exactly at the midpoint between the 61.8% and 78.6% retracement lines, which lands at the 70.5% level. We'll position our stop loss a few pips beneath the nearest swing low. The final phase is trade management and target selection. Since price is likely to react to this next structure zone, we'll set our first target just before that area, potentially at the close of the highest bullish candle. For additional targets, we aim for the -27% and -61.8% Fibonacci extension levels as our second and third profit-taking zones. Now let's quickly go over this model again using a bearish example. The same principles apply when the market is in a downtrend. First, we recognize the bearish trend, the most recent strong move downward, and evaluate how much space exists before reaching the next significant level. We're aiming to take a short position with the overall bearish pressure and ride the trend downward, so we need to outline the correction area. The recent impulsive drop began from this point and extended all the way down to here, meaning this is the zone where we anticipate a pullback or retracement to form. Now moving on to the next phase, let's use the retracement tool and map out our trade setup. In this case, we'll place a sell limit exactly at the 70.5% Fibonacci retracement level and position our stop loss a few pips above the recent swing high. For our first profit target, we will set it just before the price returns to this support zone, which could align with the closing levels of these previous candles. This area often causes price to stall or bounce, so it's a logical place to secure partial profits. As for our second and third targets, we aim for the -27% and -61.8% Fibonacci extension levels. This is what defines ICT's optimal trade entry strategy. As you can see, it's built entirely on simple price structure and retracement-based logic. Now, some may believe that a system this basic can't deliver strong results, but the truth is simplicity often wins in forex trading. Your setup needs to be clean and rule-based with no ambiguity about where to enter, place your stop, or take profit. This clarity allows you to follow your system confidently, especially after backtesting, since the results you've gathered through testing are more likely to reflect what happens during live trading conditions. Now, although this is the core structure of the strategy, we've enhanced it further by incorporating multiple smart money concepts such as fair value gaps. Now let's talk about market structure shifts and multi-timeframe entries and how they work together with the optimal trade entry model. Here we're looking at a clear bullish trend, and our goal is to catch a retracement so we can enter a buy trade at a more favorable price point. If the market drops below this key level, it suggests a potential shift in sentiment and raises doubts about the continuation of the uptrend. Within this retracement range, we can mark out the optimal trading zone using the Fibonacci retracement tool. Now shifting our attention to the left side of the chart, we notice that the previous bullish move left behind several fair value gaps. These areas act as inefficiencies in price and often attract the market back to them for a retest. Notably, one of these fair value gaps aligns perfectly with the optimal trading zone. This confluence strengthens the area as a support level and makes it a logical zone to look for long opportunities when price pulls back. However, a more risk-averse strategy would be to wait for a deeper retracement into the lower fair value gap, typically the third one, as this is less likely to be a trap setup. Why? Because the initial gaps might serve as liquidity pools drawing in early buyers before reversing to the real entry zone, this deeper level gives the market a chance to shake out weak hands and build momentum before continuing the trend upward. In conclusion, when we blend the concept of the optimal trading zone with fair value gap areas, we create strong supply and demand zones that offer high probability trade setups. Combining this with confirmation from market structure shifts leads to even better entries with more precise timing and reduced risk. We were previously in a sustained downtrend until the market began showing early signs of exhaustion. The first signal was when price failed to make a new lower low, indicating that bearish momentum was weakening. This was followed by a breakout above a key supply zone, which marked a clear change of character and hinted at a possible shift in direction. Once the price pushed above the previous high, it confirmed a market structure shift, signaling that control had transitioned from sellers to buyers and that the trend had officially reversed from bearish to bullish. This is our cue to begin searching for long opportunities to ride the upward momentum. But here's the key question: when is the best time to enter the trade? Even though momentum favors the bulls, jumping in too early or at the wrong level can easily lead to a premature stop out. That's where price action and ICT's optimal trade entry (OTE) model come into play, since the directional bias is now bullish and there's clear space between the current level and the next significant resistance above. We can proceed by applying the Fibonacci retracement to the most recent impulsive move. The ideal entry lies at the 70.5% retracement level, which sits right between the 61.8% and 78.6% zones. Known for offering high probability entries, we'll place a buy limit order at that level, set the stop loss a few pips below the swing low to protect against volatility, and define our targets according to our trade management plan. This approach blends the market structure shift with the optimal entry model to help us catch a potential reversal in its early stages with favorable risk to reward parameters. But remember this: no matter how perfect a setup may appear, the market is never guaranteed to follow through. Risking more than usual just because you're confident in a trade is a common mistake. Forex trading is a game of probabilities, not certainties. If you lose 50% of your capital, you'll need a 100% gain just to break even. That's why capital preservation always comes before profit chasing. Strategy number 3 focuses on multi-timeframe entries, a powerful method that uses 2 different timeframes to refine your trading decisions. Here's how it works. We begin our analysis on a higher timeframe, typically the 1 hour or 30-minute chart. This gives us a clear view of the overall market direction. In this example, we identify a strong uptrend on the 30-minute chart. Using the Fibonacci retracement tool, we map out the optimal trading zone, OTZ, the area where we anticipate a potential pullback and entry opportunity. Once the price retraces into this zone, we zoom into a lower timeframe, such as the 15-minute or 5-minute chart, to pinpoint the ideal entry. While this pullback appears as a downtrend on the lower timeframe, our goal is to detect when that temporary bearish move is coming to an end. We watch closely for a change of character, a signal that the lower timeframe downtrend is losing momentum and the bulls are taking control again. When this happens, it gives us a valid entry trigger, allowing us to take a long position in alignment with the higher timeframe trend. By combining the optimal trade entry model with confirmation from the lower timeframe, we increase our confidence in the trade while managing risk more effectively. You can also strengthen this setup further by integrating additional price action tools, like fair value gaps, liquidity sweeps, chart patterns, or candlestick signals, to validate the entry even more. If you found this strategy helpful, make sure to like the video and subscribe to the channel. It helps us keep creating educational content just like this. Thanks for watching, and I wish you all the best with your trades. See you in the next episode.